Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here. And as always, I'm going to help you navigate the markets by running through the most important charts and themes that we're seeing today. So much went on in the last week. It was hard fitting everything in here, but I think I got almost everything. And we're going to discuss the Fed. We're going to discuss the market's reaction. We're going to talk about the Instacart IPO. We're going to talk about the housing market, commercial real estate, so much more. So stick around to the end. And as always, if you like the content, hit that subscribe button for more content just like it. But before we begin, I just want to mention we have this big webinar next week, next Tuesday, September 26th, 12 p.m. Central Time, 1 p.m. Eastern Time. Peter Maluk and I are going to be talking about really what it takes to be a successful long-term investor. So a lot of information, a lot of good information packed in there in a short period of time. So I'm going to have a link in the show notes for you to sign up for this webinar, open to everyone. Hope you can make it. Hope to see you there. So let's begin with the Fed's decision here. And here's the question coming out of it. Are higher rates here to stay? That's what everyone is asking. And what a difference, of course, from a few years ago where it was lower for longer. Now the mantra is higher for longer. And was this a surprise in terms of what the Fed did? Not at all. And I do this every single Fed meeting. It's a fun thing I like to do, saying what the Fed is going to do. And all I do is look at Fed funds futures and look what they're pricing in, because the Fed, every meeting since 2009, has done exactly what Fed fund futures were predicting. And a day before the meeting, 99% was the probability that the Fed was going to do nothing, hold rates at 5.25 to 5.5%. And that's exactly what they did. And they continue, of course, to shrink their balance sheet. So where does that leave us in terms of the Fed funds rate? Well, we've had the fastest rate of increase in terms of that rate since March 2022. We've hiked it here with the Fed 525 basis points, fastest rate of increase since the early 1980s, which not coincidentally was the last time inflation was a big concern, big problem in the US. But here the Fed is pausing for now. The expectation from markets is that they're going to continue to pause, but we'll talk about it in a bit, what the Fed's own projection is for the path of that Fed funds rate. But looking at the Fed's balance sheet, the beat goes on here. Now we're 10% below the peak from 2022, and we're almost $1 trillion off that high. But to keep it in perspective, the Fed expanded this balance sheet by over $4 trillion in 2020 and 2021. So it's just a really small decline thus far, but this trend is expected to continue. The Fed would like to see that balance sheet reduction continue in the months to come. So interesting here that perhaps if it continues at this pace, a year from now, we could be talking about the biggest balance sheet reduction, at least on a percentage basis, that we've seen. As you can see here, in February 2009 and August 2019, we had sizable reductions, but then very quickly the Fed reversed course and started doing quantitative easing again. So we'll see. At a certain point, I don't think the Fed's done with quantitative easing, but in the short run, they definitely want to see that balance sheet come down, because inflation is still the bigger concern for them. So in terms of the policy rate, where is it in terms of easy or tight or restrictive? Well, the way I like to look at it is taking that Fed funds rate and subtracting CPI, and that gives you a real Fed funds rate number. And when that's positive, when the Fed funds rate's above CPI, that's restrictive policy. The Fed is trying to then bring down inflation, slow growth, and the opposite is true when the Fed funds rate is below the rate of inflation. So now we have a Fed funds rate in that restrictive territory, around 1.7% above the CPI. And as you can see here, for a decade plus, we had spent most of the time in that easy monetary policy territory. So this is a huge shift from the Federal Reserve, where they went from pretty much saying the status quo, the base case is easy money, to now shifting to saying we're going to keep interest rates as high as necessary to bring down inflation. So very different in terms of listening to the press conference, listening to Powell. Very different than his comments a few years ago. Now he's really talking tough about inflation, saying that they're going to keep it until the job is done, keep it in that restrictive territory. So we'll see if they actually do that. But for now, that's the expectations that they're setting. And all of the focus from the meeting wasn't on the announcement. So everyone knew that Fed was going to pretty much hold rates, and that was 100% expected pretty much. But what they didn't know is what the Fed was going to do to their economic projections and their forecasts for the path of the Fed funds rate. And there was a little bit of a surprise because the Fed maintain their projection for this year. So they're still expecting, if you believe their numbers, one more rate hike is priced in from the Fed this year. But more importantly, I think, is the longer term projections from the Fed, where they're saying at the end of next year, so the end of 2024, we're going to have a Fed funds rate still above 5%, and even in 2025 at 3.9%. And that's despite the fact that they're projecting inflation to come down over the next 2 years. So they're expecting inflation to come down, but they're still saying the Fed funds rate is going to have to be elevated here above their longer run projection of 2.5%. Now, where does the market stand? Is the market believing this? Well, for this year, the market's saying no hikes. There's some chance of a hike, but they're leaning towards no hikes. And for next year, 4.7%, so a little bit below. So the market's coming around to the idea, I would say, that the Fed is serious about this, but all of this is subject to change very quickly. So if the stock market goes down very rapidly over the next month and we see just horrible economic data develop and unemployment rates start to rise, or inflation comes in well below expectations, I think all of this will change, obviously, the Fed's forecast. And in terms of the Fed's track record, in terms of getting these forecasts correct, how do they stand historically? Well, not very good. And all we have to do is look at September 2021, so 2 years ago. And just to put you back in that time period, what was going on at the time? Well, the inflation rate in the U.S. had just crossed above 5%. The stock market, of course, was booming that year. We just had the 3 rounds of stimulus all earlier that year, and you had the Fed saying at the time that inflation was the higher inflation numbers that we were hearing about was just transitory. It was going to come right back down. Don't worry about it. It's all because of just short-term supply chain dynamics, and it's going to very quickly come back down. Now, what were they saying about the Fed funds rate? Well, you can see here, they were essentially saying that the Fed funds rate was going to be pretty much unchanged in 2022, just maybe one hike, and then just a few more hikes in 2023, ending the year at 1%. So, of course, today we're well over 5%. And the conclusion from this, if you look at their projections for the inflation rate, you can see that this as well. They did not expect the inflation spike that we had. So even when higher inflation was staring the Fed right in the face back in September 2021, they didn't see it coming. So be very careful listening or putting too much weight on these forecasts. They're going to change dramatically. The one thing you could say, which almost certainty, is that these forecasts are going to be wrong. The question is in what direction and when are they going to change? But for sure, they're unlikely to be correct. And we could see that time and time again with not just the Fed, but anyone who makes these types of forecasts. Almost impossible to do with any type of consistency. So let's talk about the reaction in the bond market. And it's really good times and bad times. Good times for new bond investors, bad times for existing bond investors. And we're seeing a significant rise in yields pretty much across the board. 1 year hit its highest level since December 2000, 5.47%. So you're talking about 23 years we haven't seen a 1 year treasury yield this high. You're talking about the 2 year treasury yield at above 5% now, 5.12%, highest since July 2006. And the 10 year, which is, of course, the most talked about yield, longer term yield, is moving higher as well. And I think this is really what is starting to spook the market a little bit. It's that investors are demanding a higher yield on these longer term securities. So the implication is perhaps that inflation is going to stay higher for longer as well. And now we have the highest 10 year at 4.49% since October 2007. And that's been extremely painful for bond investors with duration, as we'll talk about in a little bit. But the good news for bond investors coming in today is that they're not only getting the highest yields since 2007 on long-term bonds, but they're also being compensated after taking into account inflation. So if we look at the real rate here, the real 10-year yield, 2.11%, that's the highest since March 2009. So we went from a situation where you were being compensated less than the rate of inflation 2 years ago, well less than it, to today, you're actually can earn, if those expectations are correct, potentially 2% above the rate of inflation. So much better position for new bond investors, very painful for existing bond investors. I think this table tells that story with we're on pace now for 3 consecutive years of negative returns for 10-year treasury bond. That's never happened before in history. We had in the 1950s, 2 straight years, 2 different times of negative returns, but never 3, and never a drawdown anywhere close to this large. So enormous drawdown for the 10-year treasury bond, well over 20%. And if we look at longer term securities, the pain has been even worse. I think this chart may be a shock to a lot of people, because what you often hear in the bond market is that bonds are safe. There's not as much volatility as stocks, but if you look at the long end of the bond market with a lot of duration, they're very sensitive to interest rates. And when you have interest rates at extremely low levels, like we saw in 2020, you have the sensitivity go up like crazy. So a very small increase in interest rates can lead to very punishing returns for bonds. At the time, I was tweeting nonstop about this. People probably got tired of me saying this, but people were viewing these securities as risk-free and safe and a good hedge at that point in time, when really they were really almost all risk and no reward. So we had a 30-year treasury yield back in 2020 go all the way down to 0.8%. It seems crazy. People are locking in less than 1% on their money for these securities for a 30-year period. And this zeros ETF, which has the longest duration of any bond ETF out there, it hit a peak here in 2020, was up like crazy. Of course, as interest rates were declining, you were getting all of that benefit, but it was really pulling forward decades worth of return for this bond, pulling it forward to that moment. And when interest rates started to rise, we see the exact opposite. And I looked at it this week here. It's actually down 60% from the peak in March 2020, 60%. And for a stock, you'd say, okay, that's a pretty big decline, but not unexpected. For something like the S&P 500, we've seen close to that during the financial crisis. But coming from a bond, I think very few people would expect this type of risk. So you have to really know what you own and why you own it. And when bonds are yielding very little, they're definitely not risky when you have this type of duration. Now, if you bought this individual security, let's say, and you held it for 30 years, yes, you're going to get your money back. But in the interim, that security can be worth very, very, very much less than it was when you bought it. And obviously almost impossible to expect people to hold with these types of declines. So let's talk about the bond market here, giving you kind of the spectrum of this year in terms of what's performed well, and what's not performed well. We can see here, it's been a big factor has been duration. So simply your sensitivity to interest rates. And we talked about that zeros ETF having a high duration. Well, that's done the worst this year. But things like floating rate bonds, so leveraged loans, which are floating rate, has done the best. So we've had the recession calls have been wrong thus far this year. So we're seeing credit spreads tighten this year. That's helping things like high yield bonds and leverage loans, and the fact that they have low duration as well. And these leverage loans are floating rate securities. So as interest rates rise, you're receiving more on your money as a bond investor. That's helped this be the best performing sector in terms of the bond market. And if we look at that leverage loan default rate here, still pretty low, under 2%. And we're seeing similar thing in high yield bonds. So the question for bond investors, of course, for risky bonds is always, what spread am I getting today? And spreads are pretty tight. We talked about high yield bonds last week. But the question is, what's going to be the direction going forward? So if we see recessionary signals really start to emerge, and we're going to talk about the economy a little bit later, you're going to see this default rate, obviously, expectation trend up, and it'll be a more difficult time for these risky bonds. And if we saw that, you're going to see a flip in terms of this, where you're probably going to see longer duration bonds and treasury bonds start to perform better as interest rates fall. So we're in the part of the cycle now where credit sensitive securities are still doing well, but the cycle is always changing, and we'll see what happens next year. This chart is constantly changing. But the really fascinating thing to me is looking at 10-year returns for pretty much all of these securities and how low they are as compared to what we saw a few years ago. So all of those returns, as we said, for this zero coupon long duration security were pulled forward. And now on a 10-year basis, you're only making a little over 1% a year on it. And even if we look at the aggregate bond exposure here, same thing, a little bit over 1%. So that low yield 10 years ago, if we went back to 2013, a lot of people probably dismissed it at the time, saying bonds are doing well. Why should I care about this low yield? Well, this is why you care. The single best predictor of future bond returns in the long run is going to be that starting yield. So starting yield a decade ago was extremely low. Bonds have done terrible. Where are we today? Well, we have a much higher yield. Bonds should do much better over the next decade than they've done in the last decade. So good times, or at least better times, are ahead for bond market investors, but very painful if you had exposure over the last few years. So let's talk about the impact of rising interest rates on corporations. And I think the assumption would be that corporations are going to have a difficult time with rising rates. Their financing rates are going to go up. It's going to be challenging for them. And if we look at the math of it, I think it's pretty interesting that we're actually thus far seeing the opposite. And there's a few reasons for this, but this is a chart showing you the non-financial corporate net interest payments. And so corporations taking the interest payments that they're paying out versus the interest income that they're receiving on their cash and other securities. And what we're seeing here is the net interest payments that they're making is actually going down. And the reason for that is that many of these companies, like similar to, let's say, a homeowner who has a fixed rate mortgage and cash in the bank, well, the rate that they're paying on the mortgage isn't changing. So their payment there has remained static, but they're making more money on their cash. So Microsoft, I think, would be a prime example. Over the past year, their interest payment has remained exactly the same, but the money that they're earning on their interest income has gone up significantly. So that spread for a company like Microsoft, it's actually been beneficial. Now, a question that you're probably thinking about is, okay, that's fine for companies like Microsoft who are, have this fixed rate debt and have a lot of cash on the balance sheet. But what about smaller companies that perhaps don't, or when their debt comes due and they have to now issue new debt, isn't going to be at a higher level? And the answer to that is yes. So as this debt matures, for all companies, it'll be more difficult, but particularly for small companies. And this chart illustrates that. If we're looking at the effective interest rate paid by the largest companies, still very low. It's gone up, but still very low, under 3.5%. The middle 40% of companies, still, I would say, pretty low as well. But the smallest 50% of companies in the S&P 1500 are paying interest rates at just under 6%. And that's with many of these firms having that rate locked in. So if interest rates remain elevated, for sure, this calculus is going to change. But there's, similar to households, there's winners and losers, and you have to really look at the company specific. So all of those companies that refinanced in 2020 and 2021, they termed out their debt for, let's say, 10 years or 20 years or longer, they did a great job for their shareholders, and they won't have that concern. But companies who issued shorter term debt or weren't able to refinance at that point in time or need money today, let's say new issues have arose, they're going to be in a much more difficult position. So the interesting thing is this is really translating into the equity market. If we look at the relationship between small caps and large caps, the market has been punishing small caps relative to large caps very, very much so in over the past few months here. And now we're seeing the lowest ratio of small caps, so IWM ETF, to large caps, the SPY ETF, since January 2001. So we had a big cycle of small cap outperformance for over a decade following the dot-com bubble peak in 2000. And almost all of that now has been given back with this long run of outperformance from large caps. So I think part of that, at least, is that the expectation, and that's been true so far, that higher interest rates have been much harder on smaller companies than their large cap counterparts. But of course, the question with markets is not what's happened in the past, but what's going to happen in the future. And is it the case now that perhaps investors are overly optimistic on large caps versus small caps, and we'll see a mean reversion? So that's another way of saying, are small caps now becoming relatively cheap as compared to their large cap counterparts? Now, another way to look at this is look at the concentration in the S&P 500. And that continues to grow here. If we look at the top 10 holdings in the S&P, so Apple, Amazon, Google, Nvidia, all of those companies, now they comprise 30.5% of the S&P 500. And that's the highest weight we've seen with data going back to 1980. So if you're looking at the S&P 500, you're becoming much more concentrated in terms of your holdings, which is why, importantly, now more than ever, to have a diversified portfolio, not just the S&P 500, because if these 10 companies are not doing as well in the future as they've done in the past, well, you're going to have a difficult time. So concentration has been a great thing in the past decade, and we don't know what will happen in the next decade, but on the chance that the leaders of the last decade aren't the same in the next decade, that's why you want to be diversified, having more than just these top 10 holdings and having more than just the S&P 500 in your portfolio. So let's talk about interest rates and the national debt market. We hit another milestone here. Not a good milestone, not what you wanted to see, but we fully expected it to happen. But we probably didn't expect it to happen this quick. At least it surprised me a little bit. I thought it would take a little bit longer to get there. But here we are now, 33 trillion in terms of US national debt. And that's only 3 months. We did this 3 months ago, same video, saying we passed the $32 trillion mark. So very quickly adding $1 trillion to national debt. And we talked about last week why this is happening. It's very simple math. The U.S. government spending way more than they're taking in, and they have a $2 trillion plus deficit. So if they continue at that pace, we're going to be talking about another milestone a few months from now for sure. But the last 5 years has just been crazy in terms of the increase. And you can see here, 54% increase in national debt over the last 5 years. And this goes beyond that, though. This is not limited to just COVID. And obviously, we saw a huge increase there. But even if we back up and look at what the government was doing before that, they were still borrowing way more money than the economy was growing. And I think this chart really illustrates that. If we look at the last 15 years, so 2008 through today, U.S. national debt has grown at a rate of 8.5% per year versus a 4% increase in nominal GDP. So this is why debt as a percentage of GDP continues to go up, because we're simply borrowing at a much faster rate than the economy is growing. And in terms of what's the breaking point, when does this become problematic? Well, it's the situation where it's suddenly and then all at once. You're seeing what's happening in terms of interest rates. At least part of that, I would think, would be the fact that we're issuing so much more debt, and you just don't have as much demand for that debt. And the expectation perhaps that this is going to be inflationary, all of this deficit spending in the future. And so investors are requiring a higher rate on that debt going forward. And the situation in terms of the interest payments is going to very quickly become more and more problematic, because most of the debt, we talked about this a few months ago, but want to mention it again here today. Most of this debt that the U.S. has is short-term debt. Over 40% is less than a year going to mature. And if we add in less than 5 years, another huge chunk. So as this debt matures, as long as interest rates stay high, you're going to have a situation where the new debt that's replacing that old debt is at a higher interest rate, and therefore the interest payment that the government's paying continues to go up. So by some point in the next year, I suspect we're going to hit $1 trillion in terms of just interest payments alone that the government is making on this debt. And it's going to come close to being the largest line item in the budget. So when does this become a problem? When this starts to crowd out other spending and people start worrying about essential services that the government's providing, and perhaps having to cut back in those areas. So what is the government doing about it today? Absolutely nothing. As I've said before, the government waits until there's a crisis before they do something. And I think I guess the consensus, by the fact that they're not doing anything about it, is that we're not yet at a crisis. So expect to see 34 trillion at some point, probably early next year would be my guess. So let's talk about the equity markets and the reaction to the Fed, reaction to rising interest rates. And what we're seeing here is just really, so far, just a minor pullback. It feels like a lot, only because we had a period of pretty low volatility from the low here in March, a pretty steady advance here. We got almost back, within a few percent of new highs. And now we have a pullback here, just a little over 5%. And again, it only feels like a lot because of that smooth ride that we saw in the 6 months previous. So in terms of the drawdowns this year, very mild year. So not even 8% on a closing basis for the S&P 500. And that is historically low. If we look at the data since 1928, the average year has a 16% intra-year drawdown for the S&P 500. So we're at less than 8% this year. So mild year by comparison. On a total return basis, the S&P 500 is still up 14% on the year. So still a pretty good year. And that's kind of been the historical message, that you can have these big drawdowns, intra-year drawdowns, but you can still have a big long-term return. So it's kind of crazy to think about, but the average return for the S&P 500 since 1928 is about 10% per year. And despite the fact that we see an average drawdown of 16%. So that always kind of shocked me, that you can see these big drawdowns, but really they go hand in hand. You don't have the high return. You don't have that 10% return without the risk side of it. And every year has risk. It's just a question of how much, and no one can predict it going in advance of the year. I think probably people expected after last year, we're going to have another year, a very difficult year with big declines. Hasn't happened so far, but we still, of course, have a few months to go. So big fear today, of course, is that inflation is going to stick around for more than people are expecting. And of course, the other fear is that it's going to start to hit the economy, these interest rate increases. So let's talk about stock picking. And you probably, if you've been watching me, you probably know my opinion of stock picking. It's a lot of fun, but it's very, very difficult, and very few people are going to be able to outperform, let's say, a broad index by picking stocks. And that's true, I would say, even if they knew the future. Now, not knew the future in terms of what a particular stock would do, but let's say you knew 5 years ago that there was going to be a pandemic, and there was going to be a company that had a vaccine for this pandemic, and made tens of billions of dollars in revenue off of that vaccine. And they were the market leader in that. And that company, of course, would be Pfizer. And I told you that you'd probably think that that company would outperform the market. But here we are. Here's the actual data. Last 5 years, S&P 500 up 67%. Pfizer down slightly over the last 5 years. So no guarantee, even if you knew that they were going to make all of this money off of this vaccine and there was going to be a pandemic and that's all people were going to be talking about, you couldn't predict that it would have outperformed. It would actually underperformed, and there's a million different reasons for that, but it just shows you, I think, how difficult stock picking actually is. And another example of that would be Peloton, and you could say the same thing when Peloton went public. Let's say you knew there was going to be a situation where people were in their homes more and gyms were closed, and it was going to lead to a boom in sales for Peloton. Probably would have said it was a pretty safe bet that 4 or 5 years from now it's going to be higher. And initially, Peloton did extremely well, but now it's at an all-time low. It gave back all of its gains from the pandemic. It almost had a market cap of $50 billion in early 2021. I wrote a piece about it at the time, talking about how unbelievably high the valuation was for Peloton. So it was trading at, I think, over 20 times sales, which was kind of remarkable for a company in the fitness space, but people were valuing it like a high growth tech stock. And when sales growth slowed predictably, the price to sales ratio came crashing down. And today it has a price to sales ratio of less than 1, and we have a market cap of 1.6 billion. So again, stock picking, a lot of fun, but extremely hard to do with any consistency to outperform the indexes. And speaking of stocks, let's talk about the Instacart IPO. And there haven't been a ton of IPOs this year, but a little bit more than we're on pace to be a little bit more than last year. This is showing you just how crazy things got in 2020 and then in 2021, surpassing 2020's record total by a wide margin. So $316 billion in issuance in 2021, and today we're at 19 billion. On pace probably just to surpass last year by a little bit, but you can see just went from a complete mania, everyone rushing in, to almost nothing automatically. And Instacart's an interesting story because of where it priced at in relation to where it was valued last in the private market. So in, of course, 2020, 2021, there's just a huge increase in valuations for anything tech related. And of course, Instacart benefiting from that stay-at-home trend, similar to Peloton. And we just saw its valuation continue to rise and accelerate during that period of time. Went from 7.7 billion in 2018 up to 14 billion, July 2020, 18 billion. And then by early 2021, when the mania hit its peak in terms of these high growth companies, $39 billion valuation. And when it went public first day, I looked at the valuation, tweeted this out, 11 billion. So it was down over 70% from that prior last valuation in the private market. And since then, the stock has continued to move lower, and it's now back down to its IPO price after an initial jump higher, and now its market cap is down to 8 billion. So you're talking about almost an 80% reduction versus that private market. So private markets clearly definitely not immune to this type of mania. And what's interesting is Instacart investors, at least now you can see what the actual worth is, or at least what the market is saying the worth is. Whereas if you look at many private companies similar to Instacart in that tech space, they still haven't repriced in terms of, they had this funding round that valued it at this crazy valuation in 2020 and 2021. But they haven't done a down round yet, and they haven't readjusted that valuation with the new market reality. So it'll be interesting to see in the venture space how that all plays out in terms of returns in the next few years, because you had those enormous gains in 2020, 2021. But we don't have full transparency, of course, on current prices. And if you compare it to public market comps for many of these companies, their valuations would be much lower, and Instacart obviously being the best example of this. Now, how does Instacart compare to ARM, which I talked about last week? Well, I'd say much more reasonable in terms of valuation. Last week I was talking about ARM being trading at 24 times sales. It was kind of crazy for a company that wasn't growing. Well, now that's down to 19.5 sales. So it's come down significantly just in the past week. But interesting to me that Instacart actually has more in revenue than ARM, but trading at an $8 billion valuation today versus 52 billion for ARM. So still, you could see a huge disparity here. We'll see if that means maybe investors are still saying that ARM is going to perhaps grow more in the future, or maybe they're just wrong, right, as they've been. So in one sense, you could point to Instacart as saying, well, the IPO mania is not back. It's, if you look at in relation to its comps here, DoorDash and Uber and Amazon seems to be pretty close to those. So you'd say that's kind of reasonable. But then we have that ARM example, which is saying, well, investor sentiment, at least for that security, seems to be overly high. But as I said, we've seen this many times before where investors get really excited at the IPO, and then that excitement very quickly wears off. Perhaps ARM is just another example of this. But as I said last week, be very careful with IPOs, particularly IPOs that are called hot IPOs, and there's a lot of investor demand and activity because once they become public, well, now the market is going to dictate that. And if they're trading out of whack with their competitors or with the market, eventually the weighing machine is going to set in. And ARM is no exception to this rule. And we saw that with all of those companies in 2020, 2021. They had huge growth, huge expectations, and almost in every case, the expectations from investors was way too high. So let's talk about the economy here. Soft landing is the buzzword that you're probably hearing all the time, and you're not just imagining it. There was this analysis in the Wall Street Journal saying the number of mentions in the Wall Street Journal of this soft landing concept, and over the last 2 years, so 2022 and so far this year, we've seen the most mentions for a 2-year period of any 2-year period, with data going back, I think, to the early 1980s. And the only period where it was comparable was this 89 to 90 period, where we had, I think, a combined one fewer mention, as of when this report was put out. But I'm sure after the Fed meeting, the mentions of soft landing are going to increase because Powell talked about it, as I'll say in a second. Now, just because someone says there's going to be a soft landing, of course, doesn't mean that there's going to be one. In 89 and 90, there was a recession that started in 1990, continued to 1991. If we look at the soft landing mentions around 2000, 2001, that didn't end up being a soft landing. That ended up being a recession in 2001. And if we look at the mentions in 2006, 2007, of course, we know recession began in early 2008. But do we have examples where people said there was a soft landing and there actually was one? Yes, we have this 1995 example would be the one that people are pointing to. The difference between 1995 and today, of course, is the Fed was not aggressively hiking interest rates back then and combating inflation. So will there be a soft landing? It remains to be seen. But of course, just because people are talking about one definitely doesn't mean that we're going to have one and we're going to avoid a recession. And Powell was asked about the soft landing, and what he essentially said, yes, it's his objective. They're trying to achieve a soft landing, whatever that means. But their number one objective, at least for now, is price stability. And this I would agree with, because if you don't get prices under control, nothing else really matters. So for now, Powell's really talking the talk, and I would say walking the walk as well. But we'll see what happens if and when economic data deteriorates. How much is he going to stick to this inflation fighting mantra? But definitely, does the Fed want a soft landing? Of course. Will they achieve one? The history, the record in terms of the Fed hiking rates this aggressively and not having a recession is not really a good one, but perhaps this will be the first time. The market's constantly doing things that we haven't seen before. If we look at the leading economic index, though, another monthly decline. I think this is 17 months in a row where we're seeing a year-over-year decline in that leading economic index from the Conference Board. That's the longest down streak that we've seen since 2007, 2009. So pretty long time here. We're seeing leading economic indicators pointing to a downturn, and people are probably saying, well, how come we're not seeing a recession yet? Well, you can see that there can be a big lag. And if we talk about things like the yield curve, it's now almost been inverted for a year for looking at the spread between 10-year and 3-month. But that's consistent with historical inversions. You tend to not see a recession for at least a year following that first inversion. So if we had a recession early next year, that would be consistent with this kind of data. What is the Conference Board saying? They're saying we're going to see much slower growth in 2023. Last month, they were saying they're forecasting recession to begin in the fourth quarter of this year. We'll see if that happens. What would contribute to an increase in odds of a recession would be credit becoming more difficult. Last week, I talked about this on the corporate side. We're seeing lending standards really tighten significantly. But this is looking at households. That's a survey done by the New York Fed. And many people are saying it's harder to get today than a year ago obtaining new credit. So not only if you get that credit, is the interest rate going to be extremely high, highest rate ever we're seeing on credit cards, seeing the highest rates on auto loans that we've seen since 2007, highest mortgage rates we've seen in decades. So not only is it high, but it's harder to get. And of course, when that reaches a certain level, it starts to impact economic activity. So what's another leading indicator that has been slowing down for a better part of a year and a half now? Well, definitely the housing sector. And there was a brief period earlier this year of optimism in terms of home builders. And we said, hopefully, this is actually the case, and they build more homes because we're in desperate need of more supply. But that has really reversed course over the past few months here, likely because interest rates are just moving back higher again, above 7% in terms of 30-year mortgages. And if you look at the comments from home builders in the survey, they're saying it's much harder given these conditions, and they're having to offer more incentives and price cuts to sell their homes because the homes are simply not affordable. So that's translating into, unfortunately, lower housing starts, so fewer homes being built, at least for this latest reading was the lowest we've seen since middle of 2020 and down 15% year over year. So we need more supply. We need more supply to increase the inventories and to normalize prices, but we're not getting it. And hopefully this turns around. But I would say this is just another factor in terms of economic activity. That's a leading indicator that's slowing down, and not just starts, but home sales in general. We're just seeing a huge decline in existing home sales. Very few people transacting. How does that translate into the economy? Well, few people are buying homes, few people are moving. Well, that's less appliances that you're buying, less furniture, less other things. So housing sector is not determinative of, let's say, a recession, but it's not an unimportant factor if we look at the economy. And this is just another data point in terms of buyers starting to pull back. This is looking at rate of cancellations. So you're in a contract to buy a home, and then you cancel, and that hit 15.7%, which is the highest we've seen in almost a year. So, and you could see well above the average before this period. So people pulling back in terms of buying a home, likely because that the financing, I would imagine, is the biggest driver. So let's talk about commercial real estate. We're seeing a reset in certain cities, certain areas in terms of commercial real estate pricing, and particularly in terms of the office market. And San Francisco will be the leading example. Talked about this a few months ago, but here's another pretty shocking example of how quickly prices can reset when you have this situation where there's supply and not a ton of demand. So this is property 60 Spear Street in San Francisco, and recently was acquired for $41 million, which was 62% less than it sold for in 2014. So not only has it not appreciated, it's down 62%. And what's driving that? Well, of course, the situation in San Francisco in terms of occupancy is just in a dire strait. So we're talking about over 30% vacancy rates in San Francisco, and you can see this sharp move higher here. So more vacancies, less rents in terms of what the building is yielding. And if you look into the average rent that they're charging, because you have all this vacancy, it's gone down significantly. So looking at if the net rental income that a building can produce, it's gone down. Even if there were no vacancies, it would have gone down because the price has gone down. But now you have the fact that the tenants who are there are paying less and there's fewer of them. So just a huge adjustment and a reminder that the price that you pay matters. And there was not unlike the situation in the residential market, there was a huge mania in commercial real estate, huge boom, driven in large part by this low interest rate environment. And now we're in a very different environment today, and prices are resetting, and that's a good thing. And so prices will clear. They'll get to a point. So why was this property acquired? Well, it was acquired at a level where they probably said we can make some enhancements to the building, and even if there's a high occupancy, we can still make a profit at this level. And so I suspect, again, this is going to be a cycle that takes years to play out. And we talked about the reason why, but the biggest reason being that the debt on these properties, it's going to take time for it to come due. And when it comes due, they're not likely to be able to refinance. So they either have to sell at a much lower price or walk away from the property altogether. So China is seeing a real estate boom and bust that I think everyone was predicting, but now it's finally here. And we talked about Evergrande all last year, but now Country Garden is in the news as well. It's now the largest largest builder of homes, and you could see the sales of Country Garden just collapsing here. A huge decline in sales, and this is what its market cap has done, really following Evergrande. And if we look at home prices in China, you can see here sharp deceleration across all tiers. So top tier properties, second tier, third tier, we're seeing home prices really rapidly decelerating, and in terms of third tier, actually declining. And these are the reported statistics. What are the actual numbers? My guess would be much lower. And if we look at the office vacancy rates in China, I think the U.S. overall, in San Francisco, it's above 30%, but overall, the U.S. I think is about 18%. And what China is reporting here is around above 22% in terms of office vacancy. And there's reports of just empty buildings all over the place there. So again, this is a cycle that's going to take a long time to play out, and certainly much more important to the Chinese economy than the U.S. economy, given how much they invested in both commercial and residential real estate. So certainly a concern for markets, certainly obviously in terms of these companies being reflected, but the question for China is how much this is going to pull down overall growth. So I want to end with something positive, as I always do, and this would be India's incredible progress over the last century and even the last few decades, just been remarkable. And so just want to run through a few amazing stats there. If we look at in 1980, over 60% of India's population lived in extreme poverty. And in the latest data point in 2019, just 10%. And if we look at what's happened in terms of literacy rates going up and access to electricity, where it wasn't that long ago where just half the population had access to electricity, and now you're at close to 100%, and homicide rates going down. And then we just have the fact that in 1950, the daily calorie supply was way below what the average person needs. So you had hunger really commonplace across India. And today you're up to 2,500 daily calories. And for perspective, I think the average recommended for a man is around 2,500, and for a female, would be 2000. So just really encouraging to see that. I'm not saying hunger is not a problem at all in India, but certainly looking at these numbers here, much less of an issue today than it was back in 1950. And coming back to this notion that I talked about a few weeks ago, where people try to scare you saying that if population increases, then that's going to lead to problems because there's going to be more demand for resources and the resources are not going to go down and that's going to be bad for everyone. Well, I think this chart really dispels that notion where we had the population in India since 1947 is increased by a billion people between 1947 and today. It's now the largest country by population in the world. It actually passed China. Number one by population. And what happened, since that period, life expectancy doubled since 1947. So you have things getting better despite the fact that you have many more people. And that's true pretty much everywhere in the world. So we'll end it right there. Thanks everyone for joining me. If you like the content, as always, subscribe to the channel. Have a great weekend, and I'll see you next time for the Week in Charts.